Hi guys, welcome back to my channel. Kelvin here. As you can see, we have another very special guest today, and he's none other than Dhruv Arora, the founder and CEO of Syfe. Welcome to the channel, Dhruv.
Thanks for having me, Kelvin.
Can you share a bit more about yourself? Like, what inspired you to start Syfe back in 2017?
Yeah, so most of my life I was a banker. I started off my career with UBS in Hong Kong, where I was a portfolio trader, and then eventually went on to start the ETF distribution desk. I think in this process, I would say there's always, when I think about Syfe, there's always a push and a pull, right? So if you ask me what are the two factors, one was when I was in my years of banking, a lot of my friends would come and ask me, what do you do with your money? Especially if your friends, they are not bankers, they're lawyers, doctors, consultants, doing well, right? But don't know what to do with their money. Then you realize actually, there are all these people now who are in their 20s and early 30s. They now have much more money than they did maybe 5-10 years ago. And they want to do something with it, right? If you look at most of our friends, I come from a middle class family, we all did much better than what our parents did. So we have to start thinking of our finances much earlier. So that was the first part of it, right? The second part also, what you realized was whether my friends were in Hong Kong, they were in Singapore or any part of Asia, what you realize typically is that generally, culturally, we've always been told to save. So, my parents also, you make any money, put money in the bank. My mom, her number one financial advice, are you saving enough, right? Are you putting enough money in the bank? Which was good when the bank rates were high and everything. But the reality is now with inflation and what we are seeing right now, the real rate of interest is majorly negative. So something needs to be done, right? So this was, I would say, the so-called, pull factor for me, what really attracted me to do it. On a more personal level, though, I think banking was great for me. I was a director at 27, rising up the ranks, etc. I think what was missing was a little bit of purpose. When you see some of your, managing directors, you see, your bosses, and you're like, okay, this is good, he's got a nice car, he's got a chauffeur and everything, but is that the life what you want? So I think that ability to make an impact, I think that was a big push factor. And, moving away from that, a very nice, but a very, closed world of banking, I think was something which drove me to start Syfe.
Right. So you felt that you could make more impact by starting with Syfe.
Absolutely, yeah.
About that, in UBS, you were working as a trader.
That's right.
Even ranked as an outstanding performer.
Thank you.
So why not create a trading board instead, right? Because potentially it can give a higher returns compared to just some boring ETFs.
Well, so the thing is it's what you really, I guess maybe a question is, okay, why not just start a hedge fund or a quant fund rather than, launch something like Syfe, right? I think it comes down to that same point of impact, right? I think while of course, returns are great and some years a trading bot will give good returns and some years it'll give horrible returns. I think the reality is, for me, what really drove me was, can this have a wider impact? And I think that doing that by launching a platform such as Syfe, which is now trying to bring the highest quality of institutional products, I think that has much more meaning and much more impact. Now don't get me wrong, I think returns are very, very important. Right. But I also believe it's almost very tough for a trading bot to consistently beat the market, right? I think if I had discovered that, then it would be a different story. But it's easier said than done. A lot of people talk about these trading bots, but in reality, they will show you this time period where they'll do great, but in reality, they don't. So the focus was more about building consistent wealth over the long run, and which is where ETFs, are a tool. So I think one impact in the broader reach. And I think that is something which is very powerful.
Speaking of ETFs, so when I compare about Syfe's equities 100 return to something as simple as the S&P 500 VOO return, VOO has low fees and yet it still can outperform the Syfe equity 100. So then my question would be why then should an investor go through Syfe equity 100 and not through S&P 500 instead?
Yeah. No, it's a very valid and a very fair question, and a question which we get asked all the time, right? Why should I do it, right? I think the reality is it comes down to what period are you thinking of, right? If you go back in 2020, 2021, everyone thinks, oh, this is the best thing ever. But let's take a real life example. This year, year to date, right? I think at mid-year, our portfolio was also down, but down 12%. Whereas SPY or QQQ, etc., were down about 18 to 20%, right? So if you really look at a specific time frame, whether on the way up or way down, you will always see periods of outperformance, underperformance. But the reality is for us, the idea was to build a diversified wealth over a very, very long period of time. Now, just because the US had an incredible run, SPY/VO for the last 10, 11 years, I mean, this year you're already seeing it's different. It does not mean that that will continue.
Right.
And that is the premise of building for, the portfolios through Syfe. Our focus has always been on passive long-term investing. And I think it's important to know passive long-term investing does not mean that I will buy something and hold it for eternity. You hold it for as long as you can, but periodically you would review if this is the right investment. Just the way, we were talking earlier and you are reviewing, is Tesla the right thing for me now? It was right for a very long period of time. So for us also, even if you see how we rebalance our portfolios, every 6 months we will look at it, is this the right allocation? And we will change the allocation. And I think that is something, over a long run will outperform a conventional, just buy SPY or VO and hold strategy.
Okay, so just now I was comparing equity 100 to VOO's kind of performance. Yeah. But what about equities 100 to something more global like VWRA, where it has all the top stocks all around the world?
Yeah. No, I think again, the reality is that if you think of it, they normally work on these benchmarks where they will call China as an emerging market and give it an emerging weight, etc., right? And the allocations accordingly keep on changing, right? So I think, as I said, there is one school of thought that you could go for one of these kind of ETFs and see, and if you're fine with their philosophy and keep on doing it. The other option is, of course, you work with someone like Syfe, where we are constantly looking, when we build our portfolio, so we look at the factors, right? Like growth versus value, or small cap versus large cap, or volatility versus, low vol versus high vol. So the thing is, for us, what we try to do is what we call on our side at least is the smart beta aspect, right? We'll have these factors and we will try to, optimize on these factors. And that is something, again, which is very unique to what we have done. And, we've got a big investment team of, professors, PhDs, quants, etc., working on this for the last, almost 3 to 4 years, constantly improving, constantly reviving. So I think, as you correctly said, right, the reality is with any robo-advisory kind of platform, I think this question is always going to be there. But the reality is that if, you strongly have a view that, okay, this is the kind of exposure you're fine with an ETF, that's probably the right way for you.
Right. So users basically have to choose whether they want to believe in ETFs or whether they believe that robo-advisors can possibly do a better job.
I think we also use ETFs where relevant, right? So I don't think it's ETFs versus robo-advisors. We are a massive proponent of, if you ask me, unit trusts versus ETFs, I'll have a big debate on that also, right? Because I personally strongly believe how strong ETFs can be and how transparent they are in terms of multiple other aspects, right? But when you're building up a whole portfolio, I think if users know all the different constituents they want to take in a portfolio and then constantly look at them and constantly, monitor them and, buy, sell, etc., and are comfortable, getting through all the hassle of that brokerage, but not wanting to, go to a robo-advisor, then so be it. So as I said, right, people, as I said, if you know what you want to do and if you have full conviction and you're comfortable spending your time and energy, absolutely, I would not say no. But for majority of people, they don't have it. Right. And again, coming to that premise, right, one of the most beautiful use cases we have seen over the last few years emerge is this whole aspect of, on our platform, how people regularly top up. Some month they save more, they'll put 2,000. Some month they save less, they'll put 1,000, right? As they keep on adding that up, that building up that habit, which is almost a bit on, on autopilot, through someone who knows what they're doing and have a team looking at it, it's very powerful. And I think that is the distinction users need to make.
So earlier this year, StashAway phased out China from its portfolio, with the reason being they were afraid of unknowns and that it could impact their portfolio. But I saw that Syfe still has about 18% of its holdings in China. So are you not worried about the same stuff that StashAway is worried about, like wars, like property crisis and so on?
Yeah. I think the unknowns exist in every market if you think of it, right? I you could talk about what impact can the inflation that US is having will eventually have in US in 6 months, etc. But when we build our portfolios, our premise has always been to build them globally diversified. Now, if you think of China, China is give or take 18 to 20% of the world GDP, right? Or second largest GDP market. Right. So thinking of a global portfolio which does not have China just did not add up. And it did not add up in our research, it did not add up in our numbers, it did not add up on multiple other fronts, right? That I think is the first aspect. The second aspect is also, if you see, China has been already massively underperforming. So a lot of these aspects that we're talking of, such as the aspect of property or what war, etc., can do, a fair amount of it is already priced into the suppressed levels, right? I mean, you see how maybe an US market has done, how China has done. You can, even despite the correction, there's a clear divergence in the last few years. So in our view, still remain committed to the market. Of course, we constantly keep on hearing if China does contribute to the war, and if it's a whole-blown war, I think there'll be bigger issues that the whole world will have to address. But as it stands, and from all the information we know, these factors have existed. I mean, Evergrande issues, I've been hearing of them for the last 10, 12 years, right? And perhaps it'll be bigger, and I'm not saying it's not going to happen, but a lot of it is already priced in our view. Right. And if you are building a diversified portfolio, we would still maintain the thought that China needs a place in that portfolio.
Right, so you keep on holding as long as the TCs.
As I said, we are passive investors. We review it periodically, and if in our reviews these unknown unknowns start becoming known unknowns or unknown knowns, that's when we start having a secondary look at the allocation.
Earlier last year, Syfe decided to phase out the Global ARI portfolio, right? Why do you decide to just phase out? Like, I feel that it was a big differentiator among all the other robo-advisors in Singapore.
ARI actually did extremely well for us. I mean, if you look at the downturn, I think in 2020, I remember the plethora of messages, the first wave of COVID, where everyone was like, oh, thanks, my portfolio is down only 8% and the market's down 30%. And I'm like, you're welcome. I mean, you're still down, but relatively, it was much less down, right? So I think the premise of ARI, of course, was risk management and managing on the downturns, right? I think what we realized over time was the way how ARI was functioning, it was in a way where we were rebalancing it at a relatively regular frequency based on the markets, right? But then at the same time, if you look at our users and what kind of platform we were building it towards long-term wealth management. So though in the short run, I think what ARI did was very, very good. It did not align with a much kind of a longer term, vision of what our platform is, long-term sustainable wealth development, right? So the reality is I almost say this, I think phase out is a relatively strong word. We gave it a bit of an upgrade in some ways. If you look at the core tenets of what ARI was about managing risk, that core tenets also apply in our equity and core portfolios. The only difference now is that we would not look at it in a shorter duration. We will look at a much longer duration. And that's why you see lesser frequent rebalances. And in a volatile world where, markets can go up 5% one week, come down the next percent one week, I think this was a very good decision to take. And, I believe our users feel the same.
It's better to take advantage of the downturn or the volatility so that it can give a higher return over the long term.
I think it was more about the fact that we were managing risk on a much regular basis, right? So the allocations would change more dynamically. Right. But when you tie it up with majority of our users who are building wealth for the long run, they, for example, would like to dollar cost average. But today, if I dollar cost average, I'm dollar cost averaging in 80% equity, 20% bonds. If I dollar cost average after a month, if there are significant changes, I'm actually investing in 50%, for example. Right. So it wasn't really lining up with the dollar cost averaging principle and the long-term investing principle. I think this was a relatively sophisticated strategy, which probably a lot of the short-term kind of investors would really, really appreciate. Right. But for the long-term investors, we feel having a relatively more stable, passive asset allocation is something that is the right thing to do. And this is coming back to that same premise, right, where you're focusing for the long run. You are a passive investment platform, but you're reviewing the allocations, once maybe every 6 months or so. Unless, of course, if there's a major event in China, there's something else, we, of course, will review it at a higher frequency. You review it, and if there are changes to make, you will make the changes.
So earlier this year, Syfe expanded to Australia and Hong Kong with different kinds of offerings, right? And earlier last year, Syfe created Syfe Trade. So how do you prioritize between different offerings and between expanding overseas and developing all your features?
Yeah, it's a great question, right? So I think it's very important, to also realize that since maybe last year, our team has also grown about 5 to 6 times, right? The team in Singapore is already north of close to 100 people right now. So what we've done is whenever we launch new products or new markets, right? They have dedicated teams which work on such things or such features, such markets. So for example, in Hong Kong, we have a team on the ground, right? In Australia, we have an office in Melbourne with a team on the ground, right? Now, what has really happened over the last few years is that we've obviously spent a lot of time in building out our backend, our technology, our platforms. And in fact, from the very inception of Syfe, we were very clear that, look, we're going to build this in Singapore. It's going to be our headquarters, and we're going to build a solution so good that we can take it to other parts of APAC, right? So a lot of the grunt work, a lot of this development, like fractionalization engines or, same-day cash withdrawals, etc., they were already built out over the years, with the effort that we had put in Singapore. And when we look at these new markets, they're basically taking the same kind of backend piece, etc. So when you combine a very strong technology backend, and when you add it to the fact that we have, local teams or dedicated teams here in Singapore helping these local teams, essentially for us, you can think of them as parallel lines of business, and they're not really competing with each other, so as to speak.
Right, understand.
The Singapore still remains our key focus, right? So most of the effort, most of the people in the business still dedicatedly work only for Singapore.
The next question is a very popular question, which is like, when can we see Syfe offering CPF and SRS investing?
Good question again. A lot of good questions, Kelvin, today. SRS, as you know, for a few years they were actually reviewing the whole cycle. This is something actually we are working very closely with the regulators on, and there's always a lot of things happening, some interesting developments which are coming up in that space. If everything goes well, we are hoping to share some positive news, I'll probably say by early next year. Right? You heard it first on the show. So I think on the SRS side, I think that's roughly the kind of timeline we're looking at. Of course, this is something which is, again, a function of how our interactions and some of the changes on the framework that are coming in. CPF is an interesting topic. CPF is something that we have internally spoken about and debated for the last, I would say, pretty much like 3+ years, right? Should we do it? Should we not do it, etc. In our research and talking to users, we're still trying to build conviction if it is the right product to build.
Right.
And the reason I say this is that the reality is, if it was just money which you had to lock up and you could not get anything out of it, it's a different story. But now, depending it's SAOA, there is an opportunity cost involved. Now, that opportunity cost might look like 2.5%, 4%, maybe add another percent if you want to call access fees, etc., which probably sounds not too high compared to some of the other options. But if I look at an individual and if I see like their holistic wealth, right, the 60-40 thesis which the world follows, or many at least follow, is not just 60-40 in my stock or investment portfolio. It's something in life, right, that okay, I have a property, I have some kind of stable assets, I have fixed deposits, and then I have an equity. So if we look at that entire framework, one of the schools of thought is that the CPF can be seen like a very low risk or near zero risk, like bond component, giving you like 2.5%. So what we realized was the people for whom CPF investing might make sense if they want to put 100% of everything they have in equities. But this is not just the disposable cash. I'm saying 100% of their entire net wealth out in equities, maybe leaving the house or anything of that matter. And this is something that, we've done our research, we've been dabbling. In fact, we've even been looking at numbers. I know everyone says, CPF investing, it can get you like 8% returns and so on and so forth. Yes, again, if you're a 100% equity person is there, but then please ensure me, you're not putting in a 60-40 bond portfolio somewhere. Because if you're doing that, you're better than putting that 40% here and using, your rest of your cash for 100%. So that's something that we are debating on. Frankly, given all the information we have, it's a little bit of a low priority for us. Right. But again, we constantly keep on reviewing it.
Right, because like when I talked to Greg from Endowers, the reason he implemented CPF in was because CPF is basically locked for entire life until 60+. So he felt that it was good that it was locked up because users could then let the money compound in the equities side. Yeah. So that's why they introduced CPF investing, right? So you wanted to keep the bond part in investing. That's why I didn't introduce CPF investing yet.
So as I said, if you want to invest 100% in equities, right? If everything that you have wants to go 100% in equities, then I think it makes sense, right? And this might be fair for someone, who's 25, 30 years old, early in life and all. But I think as people maybe even hit 35, 40, once you have kids and you have responsibilities, I don't think many people are 100% equity exposure. I have seen, since I've got married, my preferences have changed a little bit, right? So I personally think, look, if you're in that 100% equity camp with your entire wealth, not just your investment portfolio, with your entire wealth, then great. Otherwise, I think it is something which you should weigh the pros and cons of. That's at least what our research have said. Right. So it's something that we will review. But as I said, frankly, for us, I think there are much bigger and important challenges which we as a business want to address right now.
Understand. Syfe uses Alpaca Securities and Saxo to buy and sell ETFs. The last time I emailed Syfe, they mentioned that they do not use payment for order flow, because people were asking me how was Syfe Trade able to offer zero commission trade, right? So Syfe doesn't use payment for order flow. But my question is, how would then user know that Syfe is able to execute trades at the best possible price, right?
So this, I think it's very important to know that for the wealth, we only use Saxo. All the executions that users come through the managed wealth platform, through all our portfolios, we don't use Alpaca, we only use Saxo. Right. And Saxo, as you know, is a MS regulated, well reputed. I think there's some people who also use it for their personal investing, etc. So when we use these kind of platforms, I think we have to also see how it fits up with our investment thesis and see, are they doing something which is wrong? Right. So the way how you assess whether a platform does this or not. So for example, Saxo is very clear. They don't do payment for order flow. It's absolutely very, very clear. Right? And at the same time, when we execute, we will also see, because it's ETFs. And this is where I think ETFs are very, very powerful, but also very transparent. Today, if you go on the platform, you can literally see at what price your ETF was executed, right? So you can see that it's not at a wrong price or a right price or whatever, whichever way you want to see it, you can see it and see when it was done. So how we do it is that we will see essentially what is the liquidity, like how much are we transacting, and what is the liquidity in the market. Now, one of the reasons why we chose ETFs, and many of them are US listed, are because the US markets are very liquid. So the cost of impact is nothing. Now, for example, if I'm buying SPY, it raises billions of dollars a day. Even if Syfe is buying $10 million in a day, it's nothing, right? So then, of course, firstly, what is the impact? And majority of our ETFs, we are like less than 0.1% of the daily traded volume. So you really can't have impact. The second thing is even how we choose to execute, right? We typically would have a bit of a bias to execute in high liquidity events, such as, let's say, market auctions, market closes, where essentially there is much higher, there's a fair price matching, it's printed publicly and all users can see. And doing these actually end up, creating that transparency which we always want. Because I think one thing that we are really, really proud of is whatever we do, we put it out there, right? You can go to your dashboard, you can see the price, then you can go to, your broker, etc., or Syfe Trade, see where it closed last night, see have I got the same price or not, right? So I think this is something which we always encourage users to double verify, because for us, we are very clear on the wealth product, the only fees we make is on the management fees. And within that, we actually end up paying all the brokerage, all the team, all the different charges, etc., that we have to incur.
The price that is executed is based on the last day's closing price?
Very often it would be, but sometimes if our size is too much, right, then there might be some sort of deviation in it, right? But again, whatever we execute, okay, so one of the big four auditors audits us, and they will see literally where was your executed price and what was the fill you actually got from the broker. So it's exactly the same thing that's exactly transferred onto our system, and that is exactly transferred to the user, right? So we are very, very sure. And Kelvin, this is something that I used to do for a living in terms of trading the markets, etc. So we are over conscious about everything from spreads, everything from the market impact, everything from where we are getting executed.
So what's the biggest issue for Syfe right now, especially during this whole market uncertainty?
I mean, so if I look back at this year, I think we've had some very good wins as a business, right? We launched trade earlier this year. We launched Hong Kong a few months ago. We launched Australia a few weeks ago. So I think as far as what we as a business want to build, what we want to execute, I think things have been very good on that front. But the biggest issue, if you ask me, that we are facing now, like with many others, is what's happening from the markets, right? And even though I think our portfolios generally have done much better than markets in these times, numbers, it's all public now, so you can see them. The reality is that it's a tough and an emotional ride for our investors and for our customers. So I think helping them out in this phase, and actually, whether it's through content, whether it's through access to more webinars, and recently we did even a seminar, for example, with JP Morgan, or even giving them access to advisors, a little bit of human touch, which is something that we've always done from day one of Syfe. Is very, very powerful, because the reality is it is about just getting a different perspective. Someone who's in the industry can tell you, okay, is this right for you? Can you do something else? Or maybe this is just a time, look, these waves have happened historically, this is the right time to hold, etc. So I think helping our users navigate this phase is something that, we are trying to spend most of the time on. And that is something which we want to focus on.
What's next for Syfe? Will you be adding a trading board?
You really want a trading board? Probably not a trading board. It's probably not a trading board. But I think one thing that has differentiated us over the years is that we've always been on the forefront of innovating products. Whether it was, we talked about the REIT product, or even like simple things, right? Like in our Cash Plus, we allowed same-day withdrawals, for example, like industry first, right? We allowed a ETF builder, not existent in Asia as far as I know right now, right? But allowing people with even small values to get that level of service. So I think for us, we want to continue focusing on developing more features, more products, but not just blatantly building them out, building them out based on user needs, right? So we spend a lot of time with the users, we understand, what they need. And essentially, with the same goal that I mentioned earlier, one place where people can manage their money safely, securely, and they have the advice they need, they have the access they need, and obviously at a very, very affordable price point also. I mean, if you use ETFs, which are significantly cheaper than unit trust, you add our fees, you're probably not the most competitive in an overall access, so as to speak.
Right. So let's move on from Syfe to about you. How are you personally investing your money?
So shouldn't come as a surprise, my biggest investment is Syfe, right? Of course, I think that is, when you start a company, that takes your 24/7, right? And I always say that I would give it that extra moment to to make this even better. Then save $1 in brokerage fees. Let's put it that way. Priority wise, right? But if I talk about my I guess my other kind of investment portfolio, a lot of my wealth actually initially was in equity 100. Last year, I even invested in we have a China growth thematic, etc., which we've done, again, been a bit down, but again, it's a long-term story. So very, very consistent on that. And then, as I was mentioning earlier, like had invested in some growth stocks some 5-10 years ago, which I keep on reviewing every now and then. Bought like Apple in 2012, Amazon in 2013. So have just basically kept them, and but again, they went up, came off a little bit, doesn't matter, right? I think still consistent on the long-term story of some of these companies.
Moving on, what keeps you up at night?
A lot of things. Coming back to that point earlier ago, right? Like, what is one of the challenges as a company we face? I think what we are in is a very unique phase, right? You feel like 2 years ago, there was this monetary policy, they thought, okay, we can print money and that will solve all problems. And now you are coming to this world where it's actually might be causing a few problems, right? In terms of inflation. But the reality is, I generally believe that by and large, it's a phase. We'll cross it, right? Whether we cross it in 3 months, whether we cross it in 12 months, for anyone's guess. I think whenever these phases happen, one thing that I always feel, this becomes very great time for businesses to be built, and also great times to differentiate in your offering. I think when the sun is shining or the market is going one way, everyone is, oh yeah, just come to us, we'll make you money and we'll make you money and we'll make you money. But I think it's actually these challenging times which really end up showing what companies are really made of. What that translates to is when the COVID wave happened, one of the really good things which we did was we, for example, launched a REIT offering, and a lot of people were looking at that passive income then, which was quite, path-breaking back then, right, in some ways. So the way how we think of it is that, okay, we are in this situation. We know, for example, the bond equity correlation is broken down. We know people have lost their money since the start of the year. What can we do to help them, get through the phase and get ready for that next phase? And that, in one word, I would probably call it, how can we be innovative in, what are not perhaps the best kind of market conditions, right? Because I feel that the kind of things that we are building today or we are launching today, some of it might not be that obvious in the next 3 months, in the next 6 months, but we are building Syfe for the very long run, right? Just like our portfolios, right? So I think, are we, prioritizing on the right things? Are we focusing on the right things? And are we listening to our users? I think that is something that, keeps me awake.
For the final question, what's one advice that you have for investors who are trying to invest during this whole uncertainty?
I think if I have to give one advice, I would say that I'm sure it's not been easy the last, 6-9 months. And I think it's okay to be emotional. I think for a lot of especially young investors, I think this might be the first time, after having a relatively good run up in the last few years, they are seeing significant corrections, significant drawdowns to come the portfolio. So I think it's okay to be emotional, and I think it's okay to, not feel great about some of these things. But I would also say that this is also, like I was telling you about Syfe as a business, is also a great time to sit back and reflect and see what really are you investing for, what is your kind of long-term goal, what is your kind of outlook, right? I think the last few years we had all these meme frenzy traders and all these coming in. I think probably not coming back anytime soon, but who am I to say, so as to speak. But this is again a great time to see where I'm investing, what I'm investing is aligned to what I want to achieve in the long run. And as cliche as it sounds, it's not about timing the market, and it's the time you spend in the market. So at the end of the day, looping back again, if your investment is for the long run, you should still assess it. This doesn't mean that if your portfolio is down, you just hold on to it, it will pick up, right? Of course, it's well diversified, well catered, it will. But if you're just going to be having investment in one stock which is down like 50%, and there's something strategically off with that company, or it's got some piece of news, it's not coming back, right? So I think sit back, assess. I personally can remember some of the best learnings I had in my career of personal investing was in 2011-12 when the whole European crisis was happening. I was trading, forex, leveraged forex futures, etc. Taking small 10 basis point spreads, but leveraging it, 1,000 times or whatever that number was. So I lost money and I lost sleep, and I realized they both were not worth it. Right. But it obviously then geared me into, buying some of these stocks and just leaving them. Of course, periodically review, see is the same company that you invested in. And at least back then, if there were no platforms like Syfe, if there was something like Syfe, I would have just put money there. And I want to believe that my time that I had saved, right, and focused on just what I was doing my work, it would have more than made up for any slight difference in performance here and there, so as to speak.
Thank you for the advice. I think we have come to the end of this interview. Thank you, Dhruv, for sharing your wisdom with us and sharing your time with us. If you guys have not checked out Syfe yet, do check it out. Even if you are not investing through Syfe, right, they have a lot of contents which are useful to new investors also. So which are on their website and on their YouTube also, which I will link down below. So anyway, that's all for today. Like, share, and subscribe, as I'll be posting more videos every week. Bye.